This section is about the equity method in a year after acquisition or subsequent to acquisition. So this example has skipped ahead now. The acquisition was January 1st, 2020, and now we're talking about 2023. In this year, Sun, the subsidiary, had a net income of $160 and paid dividends of $70,000. Net income for the 3 years is given. The dividends declared are given. The increase or decrease in book value is given. These are for 2020, 21, and 22. This is for 2023. Always be aware of the dates. Over the years, Parrot has adjusted its initial investment in Sun by adding the net income, equity method, decreasing the investment by dividends declared, and recognizing the excess amortization expenses. And if you'll recall, the excess amortization was $7,000 a year. $7,000 a year. And that was for 3 years. So the beginning balance on 1/1/23, actually that should have been 1/1/20, was $800,000. Sun's accrued net income was $330. Sun's dividends over the 3 years were $110. It's like a summary here. And the excess amortization for 3 years was the $21,000, $7,000 a year for 3 years. Then for the current year, Sun's net income is $160, their dividends $70, their excess amortization $7, and the investment in Sun at 12/31/23 is now $1,082,000. So we get ourselves a worksheet. Our worksheet shows the book value, the financial statements of Parrot and Sun. Now, Parrot has the investment here of $1,082,000. The equity in the subsidiary's earnings is $153. I think I did that at the end. Here, $183, which is the current balance in equity in the subsidiary's earnings is the $160 that they earned minus the $7,000 of excess amortization. That's where the $153 comes from. These are set up the same time and time again, so hopefully you'll get lots of practice with this and you'll feel comfortable with them. We did SAIDE. We get rid of the stock of the subsidiary. We adjust the assets, the net assets, to the fair value at the acquisition date. This is a plugged number. We adjust everything else based on the fair value at acquisition, and then this just falls into place. We want to eliminate the equity in the subsidiary account. That was the $153 for this year, the $160 minus $7,000. We want to eliminate the dividends that Sun paid to Parrot. That's $70,000. We want to do our excess amortization, and these are intra-company liabilities and receivables. In other words, one company owes the other money, so we eliminate those. We put all of those into the worksheet. We do our worksheet across just as we always have, keeping in mind that we're adding down for the totals. We added down. This is the net income. It carries forward into the statement of retained earnings. Then when we do the statement of retained earnings and we get the ending balance, and I picked up the wrong numbers again. I apologize, and I'm going to fix them right now. We get the retained earnings at 2023 at 12/31. That carries down into the balance sheet of 2023, December 31st. Our goal was to get rid of the investment in Sun, which we did, to eliminate any of the intra-company transactions, Sun's equity accounts, intercompany dividends, intercompany payables, record the excess amortization, and of course eliminate the equity in the subsidiary earnings. And I'm using and will continue to use examples from the book for all of these.